Roger Lowenstein, When Genius Failed, The Rise and Fall of Long-Term Capital Management. Embark on the intriguing journey of long-term capital management, LTCM, a hedge fund company that was once the world's largest, only to spiral into failure. With our summary of When Genius Failed, The Rise and Fall of Long-Term Capital Management by Roger Lowenstein, learn about LTCM's strategies that relied on arbitrage, complex market predictions, and massive leveraging that thrust the company into unprecedented growth. Discover how LTCM brought together some of the brightest minds in finance, only to be undone by human error, market anomalies, and an unwavering adherence to flawed models. Get ready to glean crucial lessons on the perils of overconfidence and the importance of understanding the risks, as well as gaining an appreciation for the unpredictable nature of financial markets.
The Rise and Fall of LTCM. LTCM, a hedge fund founded in 1994 by trader John Meriwether, became the largest hedge fund ever by managing their investments with a strategy called arbitrage. They used academic calculations and predictions as well as the latest computer software to recognize opportunities and exploit them quickly. However, LTCM played an important role in both the 1997 Asian financial crisis and the 1998 Russian default, bringing the financial world to the brink of collapse. This lack of regulation makes hedge funds a ripe environment for investment in riskier financial products, such as derivatives. Leveraging for profit. The story of how LTCM borrowed heavily to invest in financial product anomalies that banks thought were low risk. However, their leverage rate eventually reached 30 times the amount owned by the fund, leaving the company at risk if things went wrong. LTCM was a hedge fund that utilized a strategy of betting on tiny discrepancies between present and future prices of financial products. For this strategy to yield significant profits, they needed large investments, which prompted them to leverage heavily. The fund borrowed money and urged investors to make sizable investments to maximize potential returns. Banks loaned huge amounts to LTCM because they believed that the strategy involved minimal risk, betting on financial inconsistencies that were thought to be little affected by market fluctuations. Dresdner Bank in Germany and Banco Garantia in Brazil were among institutions that lent vast sums to LTCM. With an investment capital of just $1.25 billion, LTCM could borrow enough to invest around $20 billion. Banks were enticed by the profits the fund promised, but they did not understand the risks involved. The hedge fund had total control over where they invested borrowed money, leaving banks with no say over where their money went. As more banks lent the fund money, LTCM's leverage rate surged, eventually reaching 30 times the amount owned by the fund. This left the fund highly susceptible to risks if things didn't go according to plan. Ultimately, the fund was not able to survive the financial turmoil that happened in the late 1990s. However, the story of how LTCM employed leveraging to make huge profits and how it ultimately became their downfall remains a valuable lesson for the finance world. The academic versus trading world. LTCM was a hedge fund that wanted to bridge the gap between academia and the real world of trading. They recruited Nobel Prize winners and other experts to prove that their complex mathematical formulas could eliminate risks. They were upfront about the potential downsides, and their arrogance was fueled by their ability to predict market trends based on historical analysis. Investors were lured by their academic approach and universities invested millions. The policy worked, and the fund was successful until it fell apart in the late 1990s. This book focuses on the people behind the fund and how their obsession with financial risk management contributed to their downfall. The Rise and Fall of LTCM. In the 1990s, LTCM was the most popular and profitable hedge fund. It controlled more assets than investment banks and borrowed significant amounts from banks at low interest rates. However, their reports were not transparent, and they were relying on a deceptive strategy. The signs of failure began to show, and their success could not last forever. The fatal flaw of LTCM. LTCM became popular due to its academic models, which assumed the financial system was directed by rational people. However, humans are irrational and panic easily, causing problems during the 1997 Asian crisis. While bonds are secure, LTCM decided to increase their share of equities, a riskier financial product, when the crisis began. Despite knowing very little about these products, they invested heavily based on their models' predictions. This ultimately led them off a cliff, as they continued to follow their models even though profits were dipping. LTCM enjoyed a period of success, but their downfall resulted from their reliance on academic models and underestimation of human error. LTCM's risky business. The downfall of LTCM, a hedge fund with risky strategies, was caused partly by its reliance on mathematical models that assumed markets would always return to their natural position. These models led the fund to continue taking risks during the Asian financial crisis, even after the market failed to stabilize. LTCM's large size and high leverage rate prevented it from making money from its investments, and the fund became more reliant on the models to earn back mounting debts. Eventually, the models failed completely, leading to the fund's downfall. The Unforeseen Collapse. LTCM, known for its flawless financial models, faced a disaster when the Russian government devalued its currency, sending shockwaves throughout the market, making investors realize that they couldn't be saved every time. People started seeking only the safest bonds, leading to a mass exodus from the market. Which was terrible news for LTCM. Their losses stretched to $533 million, and they were stuck with $125 billion in assets which they couldn't sell. This forced them to open their books to demonstrate their capability of paying back their loans, but the banks had already started attacking the fund to recuperate their losses. With no other choice left, they made an alliance with a bank to save them from complete collapse. The Rescue of LTCM. As the hedge fund, LTCM, started to collapse, banks invested in it realized they would lose their investments and the market would be wrecked. Many banks and investors started looking for ways to rescue the fund, but its sheer size meant no single bank could do it alone. Letting LTCM go under was not an option since it would destroy the remaining confidence in the market. Therefore, the Federal Reserve stepped in to create a consortium of banks to deal with LTCM. The consortium succeeded but gave enormous negotiating power to LTCM's bosses. Despite its early success, LTCM lost 77% of its capital, and one of its founders kept his assets and avoided personal debt before launching a new hedge fund.
The tale of long-term capital management serves as a compelling reminder of the inherent dangers of overconfidence in financial models while disregarding market uncertainties and human irrationality. Though initially immensely successful, the fund's arrogant reliance on flawed academic strategies and excessive leveraging eventually led to its catastrophic collapse. This fall had an impact on the entire financial system, culminating in an unprecedented consortium of banks stepping in to prevent total disaster. LTCM's story reminds us of the significance of understanding risks, remaining cautious despite lucrative prospects, and questioning the validity of mathematical models that predict market behavior. The key takeaway is the importance of humility and prudence when navigating the unpredictable world of investment and finance.